Hello. Welcome to Sensedia Talks, powered by our special partner, AWS. And I want to give a shout out to AWS for making this experience for you possible. I'm Lisa Arthur, and I'm thrilled to have our two guests with us today. Paolo Malinverno, our Chief Strategy Officer, and Filipe Torqueto, Head of U.S. Solutions. And our topic today is why the upcoming open banking regulations in the U.S. are good for everybody. And we're going to talk a little bit more about how they paved the way for a concept called open finance. In the U.S., Section 1033 of the CFPB will set the expectation for consumer sharing data between financial institutions and their members, if it's a credit union, or their consumer banking customers. And that's what our webinar is going to talk today. Why is this good? And we're going to talk about some of the landmines and things to think about. One is to look at it tactically from an open banking compliance, kind of check the box approach. And the other, and one that Sensedia believes, is to use this opportunity to look at open finance as a service. And we're going to talk about that in a moment and how that can help really improve some of the challenges out there many of the financial institutions are facing with integration and innovation. So, Paolo Torqueto, welcome. It's great to have you here, and I know our audience are going to learn a lot about you. I want to dive in, and let's start with the big picture. Torqueto, I'll ask you, I think you've read every word of that CFPB 1033 regulation. Can you give our audience just the highlights here, the big picture of what it says and what it does not say?
So the US market is of course, it's large and mature, right? So the concept of open banking is happening in the US since 99, 98, right, with the Financial Pact. Although 1033 comes to put some guidance, some very neat guidance on top of it. To summarize it, 1033 provide the banks and saying to the banks that they need to provide the control of the data that is on the bank's power today for the consumers. So it's essentially CFPB is wanting to put the power on top of the consumer, right? The banking customer. Because actually this is where the data belongs, right? The data belongs to me, which is a bank customer at the end of the day. So to summarize everything that the regulation, trust me, the regulation is very extensive. There's a lot there to cover, and it's not easy, but to summarize is very easy because it's basically put the power to hold the data and to share the data accordingly to the banking, not to the consumer, not to the bank. So this is the summary of the 1033, right?
Excellent. And Paolo, as a former Gartner analyst, I'm really excited for you to share with the audience how you would define open banking and this concept open finance, and then what are the pros and cons to each?
Okay. Well, let's start from what open banking is first. The Gartner definition is is reasonably short and is remarkably clear. Open banking enables access to data and services across ecosystems of third-party financial service providers, banks, and their customers via open APIs. So that is the definition. So if I compare this definition with what Torqueto just described as what the regulation is, the regulation is, if you want, a stepping stone towards open banking, because the regulation typically covers, as Torqueto said very clearly, who owns the data, and that is the customer, or even a small business, because it's not only about end users and citizens. So once the rules as per this regulation are clear, and once the ownership of the data is clear, then open banking can happen. Open banking is about, as I said, the controlled sharing of that data through an ecosystem of providers. And that's typically the ecosystem of a bank or a financial institution, but it could be not even, it could be a non-financial institution either. It could be a fintech, it could be, many other actors there. But as a consumer, I would say, look, this entity is going to be able to see, I don't know, the balance of my account. Oh, this account, not this one. Okay. This provider is going to be able to see only my money transfers. Okay. So, and it's about the consumer deciding that, if the consumer wants, and confirming that sort of clearance in time. So why is open banking different? Because once you have that capability, the bank can go to fintechs and say, look, Mr. Fintech, a lot of my clients are your clients, and they're asking me, to provide access to you, to the data, because then you can do, I don't know, a nice mortgage search, or what is the best place to get microloans, or I don't know, some financial investing app, or even, you might, if you go to open finance, so, beyond banking, it could be an insurance. It could be a way for you to get quicker life insurance, or it could be any other way of getting any sort of insurance, like home insurance or car insurance. How much am I paying for, I don't know, the lease of my car? That is something that you might want to disclose as a consumer, or you might not want to disclose. But if you do, then you're going to enable somebody else giving you a best deal, right? Because they will know every detail about you, and you want them to know every detail about you for your, best, if you want, car insurance. So that's what open finance here is. So it's, the regulation is just the beginning, is a stepping stone, but experience in other countries has proven that once you open that Pandora's box, all financial institutions are able to give customer better services. And from a bank perspective, giving their customers the ability to share that data in a controlled and secure way according to the customer choice makes them keep the customer. Is a good thing from the bank perspective as well. But we'll get to that.
Well, and that's an interesting comment, Paolo, because we're part of the Financial Data Exchange, FDX, and we recently had a webinar with Don Cardinal, the managing director, and he interviewed Sicredi, one of our customers that is a great example of open finance in action. And the question of the fear of mass exodus came up. Okay. And I'll point it back to you. You said exactly what we heard from Sicredi. There is no mass exodus when we open and share with our consumers. You just said the same thing. Could you elaborate on that? Because I think there's a lot of fear, uncertainty, and doubt out there.
Obviously, I heard it from Sicredi as well, but I heard it from literally hundreds of other financial institutions across the globe who went through this journey, and it is true. The thing is, customers are all fine when there is this nice little financial app. I know it could be a super app where they see all of their financial status. It could be an investing app. They are fine. But when it comes to their own money, they are very happy if it stays where it is, in the financial institution, because that comes with a lot of, sense of security and stable entities to have a relationship with and so on. So by giving your customers the ability to use this new advanced application in a very disciplined way, because you decide yourself what goes there and what they're able to see. With secure APIs typically, okay, which are not, subject to, fairly kind of easy hacking as we might with other means, and we'll get to that. But the ability to give your customers these choices makes you keep them, makes you keep the customer, and it's proven, And the bank can do more on that, can do that with the partners, they can share the revenues if they want to, but it is proven, and if you think it's logical, because customers are okay with their money sitting in the bank. It gives them a good feeling, and that is not just old people like me, but is even much younger generations than me.
Well, and that's a really interesting point as well, because open finance, a broader, more holistic approach to all financial products and services, right, than just the banking, really caters to the up-and-coming generations that are digitally native and expect everything, not only online, but to be super simple.
And, a fairly large chunks of, say, Generation Z, I think you say in the U.S., right?
I've lost track of the alphabet. I've lost track
Generation
of the alphabet.
Z, do you call them? Okay. But anyway, the very young ones, a larger chunk of them, and depending on which statistic you look at, but it could be as much as 1/3 of them, they don't think they will need a bank ever. Okay, obviously they might change their mind.
Yeah.
If I look at when I was 20, I did change my mind about a lot of things. But starting, that's 1 out of 3 potential customers that, in the status quo, are not interested in what you as a bank offer. Okay, I'm sure you would like to get some of those, And these people, they just have their phones, they look at their apps, they don't expect any kind of personal service, they expect personalized service, but they will never walk into a branch. Okay, so it is a way also to address that, if you want, section of the population.
Excellent, thank you. I want to keep diving into this for our audience, and Torqueto, I know you and I work closely together, and there's a lot of conversation in the market about the role that financial aggregators play in this model of open banking. And I think it'd be really helpful for our audience to, talk about what has been and what will be.
So, history, right? Open banking is not new, and not the new word, nor open finance is out there for more than 10 years. But here's the thing, aggregators were there since the beginning, at least on the US market, when basically institutions are way more close. They were protecting themselves at any cost, so data was in vaults, literally. And aggregator starts screen scraping, which is basically the only way at the time to access data, to do kind of open banking, which is the only possibility at the time. With that said, for years, depending on the region, so Europe is more mature, Brazil is now maturing, for years the only possible way to do any kind of open banking or finance, as you wish. And they have much success with those screen scraping methods and other methods that are not based on regulations and open API specifications, right? With that said, they know a lot. They have a lot of knowledge and they aggregate a lot of data. So they are important to the ecosystem today, and they will remain important for the ecosystem in the future with open banking, because aggregators are also shifting to a more mature and open API-based scenario with the regulations across the globe, right? So aggregators are important, although there is a lot more to come, and there is a lot more freedom for institutions to build their own ecosystem in the way that they like, right? Like I said, in the past, one of the fewest ways to do open banking is scraping and go with one aggregator or more than one aggregator, right? To build something. Now, okay, your ecosystem is pretty made with the aggregators, although you have an endless world of options with open banking and different regulations across the globe and in the US now. How you want to build your ecosystem. You can use specific patterns using open banking and open finance today to go after specifics, or to open your own, to have way more control over the data that you have, and you can be able to offer what you want to offer to your partners as well. Meaning, I have a very special partnership with a kind of fintech that, for example, provides loyalty program that for my customers, this feature is extremely important. With the open banking pattern, you are free to go direct with this partner using those APIs and using those free standards that open banking will set this tone. Of course, aggregators, like I said, they are important today, they will remain important, although it opens up more opportunity in more ways and more secure ways to do open finance and open banking across the globe. So there's a lot of nuances that this regulation adds to the table, because, like I said, the power of the data will belong to the owner, real owner of the data, which is a business that is sitting on the bank, or myself that is have on a bank account, right? With that control and with the consent control, and the possibility to the banks to create their own ecosystem, during the time, they can decide and then can pick and choose where to put their effort, if I'm going to go direct, if I'm going to go with the aggregator, if I'm going to have a hybrid strategy to have a better start or a faster start with the aggregator that already have an ecosystem, and while building mine. That really depends, but the point is the open banking open up doors for the market to build things differently. And to the Paolo's point, we have digital ecosystems everywhere. Those born digital generations will demand it.
Now, a question to follow up with that. And you've been in a lot of the discussions with some of the banking and credit union executives I've been. After the first big challenge, which is integration, which open banking, open finance promises to solve, they talk about the resource constraints. If I'm out in the audience and I'm one of these financial institution executives, I'm sitting here thinking the vision sounds wonderful. It's good for everybody.
Yep.
It's holistic. It drives business. But can we really execute on it? Or is it now? And how do we do that? What's your advice for those?
So this is basically, like I said, early birds, for me, will have a very big competitive advantage, because open banking is happening, is already there. It's not an option that, oh, if will happen. It's not like that. So the US market, for example, when I'm going to request a mortgage or something like it, it's open banking right there. It's being made by screen scraping, we know that. But here's the thing, CFPB is on the edge, and now it will happen. So this entire ecosystem will shift and change, right? So you can be on the posture that, okay, I will wait and see where this is going to happen, but this is the risky point. Ecosystem are a time creation, right? For you to create your own ecosystem, it takes time naturally, because there is a bunch of stakeholders involved. Resource-wise, for me today, with clear open API specifications and a cornerstone on the regulation, it's way better and less stress on the resources to build those kind of ecosystems. So if you already have a ready-made service for you to consume that will allow you to be and to cover the regulation check, which is not that hard because we're talking about open API specs, which is not rocket science. Although, if you have a partner that you can pick and choose, or partners, to help you in the ecosystem, this is for me what is a game changer, and this is exactly what we're doing across the globe. So the Sensedia case, it's an ecosystem case, right? So this is exactly what we want to let our customers and partners know. Open banking is an ecosystem, and it allows you to build together. And if you're concerned about resources, nothing better to coexist and grow together with other resourceful and strong companies and insert yourself over this ecosystem to play along with them. So this is open finance in a nutshell, right? So resources, okay, are going to spend resources to build open banking, but the reality is you're spending resources to participate in a very big, and you can open doors that you don't even imagine. So why not? Right.
No.
Can I expand a
please.
little bit on that? Because you're going in a very interesting place with this, openness and ecosystems.
Mm-hmm.
In finance, insurance is by definition built on an ecosystem.
Yeah.
In the moment you have a little crash with your car, the car needs to be assessed by a partner. Okay, then the partner needs to say, so much is this is going to be, and is this okay? And then the insurance obviously has to connect with the bank to understand, payment for all that. And that's not only about cars, if you think about healthcare and health insurance. Obviously, there's a lot of fairly confidential stuff that should go back and forth between healthcare institutions and the insurance. So when you take an open finance ecosystem, if you want, look, you go onto something that by definition is an ecosystem already.
Yeah.
And open APIs where the information is exchanged in a secured way can only make things better and quicker. And competitive car insurance is. If there is an insurance policy that gets my claim, I get my car fixed in 2 weeks instead of 4, well, I like that. That's a competitive advantage.
Yeah.
Right? So all of these things are gradually opening up. And it is a good thing for the real customer. It is a good thing for the insurance institution as well. So it's not only about banks, but if banks open up, then insurance can open up, and it's a value chain that is very, very powerful.
And to back your question, so resources, right? So if you have this mind that, okay, I'm going to spend resources over something, that's fine. You're developing, for example, a new feature. So I have X resources to develop X features. But here's the thing with open banking, and to Paolo's point, this is competitive advantage, and it's way more than just a feature to check in a box and, okay, I have this feature like everybody else in the market. And back to the game of aggregators, not aggregators, ecosystem. So you are able to create, basically, using the features that you have and using the market research that is unique for your institution, you are able to create, based on this data and this knowledge, something unique that gives you advantages. You can go along with everybody else and check the box. Yes, you need to because it's regulation. But the point is, you already need to do that. Why not the next step, which is fairly easy? Right? So APIs are there.
Let's talk a little bit more about APIs. And you mentioned something early on, Torqueto, when we were talking about screen scraping and data aggregators. Paolo, I know you've got years of looking at these things, and I'd love for you to share kind of about ecosystems, or not ecosystems, but screen scraping, and that versus secure API access. Because you've said controlled and secure APIs.
Yeah.
So I'm feeling like this has got to be something our audience wants to hear about.
Yeah, it has to come up. yeah. I've seen banking regulations across the world. They always start with the data sharing, which is what this regulation is doing in the U.S., but they will progress. They will progress into many things. Okay. I've also talked numerous times with banking security people in the U.S. who are kept awake at night because when a banking customer gives banking credentials away, the risk of abuse of its financial data is very high. And typically, because the bank traditionally is the custodian of all of this information, and the customer gives away the credentials, that negates a lot of the power that banks might have to secure that. Giving your credentials away is the way you enable screen scraping. Okay. And obviously this is very cultural. In the US, people don't think much about doing it. In most of the countries, people will tell you you're mad if you do that. But the US is like that, and has been doing that for quite a long time.
The Wild West.
The risks of doing that, not just in terms of, you give your credentials away, somebody could just, transfer money. If some financial institution or some of the people you give the credentials away gets hacked, it's wide open, right? And this is what keeps a lot of security people in. It's not only banks, it's also credit card institutions awake at night, and actually sometimes awake during the day as well. So, and I'm actually taking the joke from a guy from MasterCard who said that. But you see, so it's about making it a bit more disciplined and more secure. It's about running those risks down. And when open banking regulations evolve across the world, it does get to screen scraping at some stage and makes it either incredibly difficult or outlaws it completely, which it's a half revolution because, as Torqueto said, especially in between aggregators is a method that is very widely used.
Well, and the Section 1033 is definitely taking a different approach than screen scraping in the way it's signaling
By the
open
way,
banking.
before you say that, in the Gartner definition of open banking, it does say at the end,
API.
via open APIs.
So,
It's a really key point, Paolo.
yeah,
Thank you.
So there is also a point of it, right? So I take a bank. We put the money on the bank. Right? So we trust our money to a bank. So let's take the same analogy to data. Bank have a lot of our data. Payments, money movements, etc., right? If we give away our credentials to screen scrape it by any means, it's free access to your bank account or whatever account to do whatever they want, right? They can claim that they are not using the data for other methods and other means, right? But it's a claim. You have no way to make sure that the data is not being used to something else. This is the first point. Second point is, like Paolo mentioned, breaches. we're seeing breaches popping up everywhere, every time. So if there's a breach on a data aggregator that is doing screen scraping, is basically a breach from banking credentials. And that's it. They're free to use. And they're out there in the dark web to do something, right?
Yeah.
With that said, why I'm doing the analogy, banks are very good at the money part. You're going to give your money to the bank and you're be sure that your money will be there in the next day. Data is the same thing. So I provide you the data and everything that I have, but I want the control over it. I don't have a bank making money movements in my behalf. Why they're moving my data around without my consent, which is the exactly part that 1033 will put in the regulation. Over the user consent, you can use the data for the purpose and strict purpose of the consent. Screen scraping don't have that.
That's a great way
And
to
actually,
wrap that up.
can I make
Oh, we're not going to wrap it up. Okay.
No,
Go ahead.
no, no.
This is a
I have
passionate topic,
a
audience.
malicious ex-Ghana analyst point to make here. If there was no abuse of that data, do you think governments could go through the trouble of getting a regulator to say,
There's this point.
you know,
as
do
well.
you think that they will just get that kind of, you know,
Friction
headache?
with those
You know,
institutions.
obviously the reason why they do it is because there are abuses of that data. You know, otherwise they wouldn't get into that trouble.
Absolutely. And that's good for the consumers that the government is looking out for them. You both talked about security and issues around screen scraping. Let's go ahead and talk about other security benefits and risks that open banking, open finance present. Because I think there is doubt out there. Some people hear open banking in the financial world, may not be well versed in it, and think that it's open without governance. And we've heard this, that it represents more fraud risks. And actually, I'm hearing the opposite from you. So let's bring this home.
Let's break the myth. Open banking and open finance. Yeah, it's scary because it's so okay. Hold on. Like I said at the beginning, screen scraping is happening already since 1999, right? Since forever. And we just said that there are abuses. We all know that, right? And there are major risks, and there is no coming back. For example, if I provide my banking credentials to a third party, and this third party is doing something with, I'm not consenting with my data, or this third party get breached, there we go. There is nothing that the bank can do because the credentials are shared. The security points and the security measures that the banks are doing, it's until that you provide your credentials to a third party to do something. They have your credentials. The gates are open, like Paolo said.
Yeah.
Right. So this is the old method. What we're saying with open banking is basically controlled, consent-based, and it's not screen scraping. You're not sharing any credentials to anybody. So it's full control to you as a data holder to go to the app and say, hey, I don't want this anymore. It's fine. Unsubscribe and be happy. But more than that, if something goes south, the bank knows where the institutions that is consuming part of the data is coming from, and they can go there and cut the channel with the APIs. So it's not less security, it's way more control and security for the data owner and for the bank. Like Paolo said, we are keeping somebody awake on the security zone of the bank during the day and during the night. With those controls, they have the means to act as well if something goes south, and it's way more secure over their own infrastructure, right? So there are some banks forbidding screen scraping, for example, but there's no way to make sure that it's forbidden, right? So if I cut an API access for somebody, no come back, you just cut it. There's no consent anymore, no access. That's
Makes
as simple as that.
sense. Anything to add, Paolo?
Oh, it's all very true. So I think you put it very, very nicely. So for once, I would not add anything.
All right. Well, we're down to our final minutes in this podcast. And, we started with the topic being why the open banking regulations in the U.S. are good for everybody. And I think we've talked about a lot of benefits, but I'd love the two of you to sum those up as key takeaways. So maybe we start with you, Paolo,
Okay.
and then Torqueto, you.
Yeah. For end users, I think we went through the benefits in basically being in control, who sees what, and also the ability to access applications and new things outside what is currently the offering of the bank, but by keeping your money secure with the bank of choice. So you have much more control, you have much more options in terms of the things you can do with your money.
Yeah.
For the banks, yes, it's much more secure. Not only opens new revenue of business, the security case speaks volumes, And these are like the usual, the usual things the usual thing banks make money on, like loans, microloans, and mortgages, and so on. It does. We didn't talk about AI at all, and maybe we shouldn't talk it during the wrap-up. But because the way to access a lot of API of AI content now is API, the bank can use that to speed up their processes, and with the consent of the user, they know what they can do that with, It's also good for, the plethora of new financial players out there, because they have a safe way to not only satisfy customers who want what they're doing, but also to deal with the banks these customers are sitting. So that's why it's good for everybody.
Thank you. Paolo.
Maybe I should talk also about small businesses, because the bank, especially credit unions, can come up with very innovative things to do to serve their small businesses and make sure that they spend their time, filling cups of coffee instead of finding out why they didn't get the last loan approved.
Yeah. Interesting. Torqueto?
Just one thing to add. Open banking is to add competitive perspectives to the market. Right? So the big players, okay, they have endless pockets. We know that. Although, how about the smaller ones, right? So open banking basically provides the same baseline to everybody. So you have the same baseline as the small institutions, as the big ones. So have the access to the same information, to the same data, to the same potential customers, to the same baseline. So it equalizes a little bit the competition, right? And provides fair competition at the end of the day. It's not like everybody who have more money will win. No, we have the same baseline. We have the best service and the best approach will win because the services, again, have the same baseline, right? So for me, the main role of open banking is to add the competitive scenario to the entire banking system as well. And of course, on top of everything that Paolo already said.
So I'm hearing control, I'm hearing security, I'm hearing growth driven by what the market wants, and I'm hearing a competitive advantage that could help smaller institutions leapfrog.
Yep.
And offer what makes them unique, which is that local community service, member focus, financial wellness, and
Yep.
literacy. Thank you. I want to thank you, Paolo. Torqueto, you.
Thank you very much.
I know
Thanks
it's a
for having
busy, busy schedule at this conference, so we're glad you still have voices. And to our audience out there, I want to thank you for listening. If you'd like to hear more, we have a lot of information on our website. Please check it out. You'll find the Sacregi case study. You'll find some open banking basics. And you can send us a note, and we'll promise to connect you with either Torqueto, Paolo, or maybe both. And with that, I want to give a final shout out and thanks to AWS for sponsoring APIX Experience Talks 2024. And we're going to wrap this session on why open banking in the U.S. and its regulations are good for everybody. I think you've both built not only a case, but if I were a financial institution, I'd be an early bird too. Many thanks. Muito obrigada. Muchas gracias. We'll see you soon. Thank you.